Recently, I was looking through the Houston Multifamily Foreclosure list for May 2026. There were around 22 properties on the list. But what shocked me the most wasn't the number. All of those loans were originated between 2020 and 2022. These were deals brought during one of the lowest interest rate environments in US history. And guess what? How many of them are collapsing on May 6, 2026? We toured a 200 plus unit apartment property that's now heading into REO sale. The long terms sounded like something that you would never get again, that investors used to dream about. 3.19% interest rate for 7 years interest only, and it was locked for 12 years. At the first 7 years, there's no payment for principals at all, just interest. People would have called that perfect debt. And guess what? The borrower stopped making interest payments since January 2026. That deal made me realize something more important is that low interest rates did not eliminate risk. They simply allowed people to massively overpay for assets. And now the market is slowly exposing how much of that equity was never really there to begin with. The risk never disappears at all in any environment. It just moves somewhere else. Low interest rate does not mean low risk. The biggest factor in real estate is not always that cost. It's whether we overpay for the asset. 2020 and 2022. Capital was everywhere, and a lot of investors were also so aggressive. They were thinking that the market would go up all the time. People started underwriting deals based on future rent growth, future appreciation, and future refinance assumptions, and the cap rate compressed hard. Some deals that were presented to trade at 6.5 caps suddenly trade at 4 caps. Sometimes it's even lower. For example, Austin, Dallas, Phoenix, Miami, Orlando. Prices exploded upward always, like during 2020 to 2022, and buyers justified it by saying, oh, it's okay because the debt is so cheap, money is so cheap. But the truth is, the savings from lower interest rates were tiny compared to how much extra people pay for property itself. It's the trap. Cheap money inflated asset prices. We thought that the highest number we could pay was 15 million, but some cash buyer pays at 18, even paid 19, 20 millions to get those deals. And when the borrowing becomes so easy, so cheap, everyone can bid higher. And when everyone can bid higher, the seller captures most of the benefits at that time. Not the buyers. A lot of buyers bought those property in their 2 or 3 years future price. A lot of investors in 2021 weren't really buying cash flow. They were buying hope. They were still imagine that the future interest rate would still be the same. When as 2020, 2021, people were believing that someone else would pay more later when they had to exit the deal. And the most dangerous market environments are usually not when people are afraid. They are when people believe they can't lose. That's when underwriting becomes fantasy. When everybody is so hopeful for the future environment, that's when the risk quietly built under the surface. So why Houston is getting hit so hard? Not just Houston, but in Texas, Austin, Dallas, Houston, San Antonio, Arizona, Florida. These markets are becoming so clear examples of this circle because several things happened at the same time. First, in these markets, the massive supply showed up in the market and a huge number of multifamily projects were delivered over the last few years. Secondly, operating expenses exploded. Our payroll increased quite a lot, and also the repair materials and also the fees that we have to pay the contractors. The insurance also increased quite a lot. And don't forget about the property tax. As Well, even we keep the income or revenue the same, but the NOIs actually dropped quite a lot. We had to offer concessions since beginning of 2025. Our competitors were offering half month free, 1 month free, some of them even 1.5 months free of rent to any of the new applicants. That means we have to adjust our marketing strategy as well. And also in some of the markets that we have to lower our rent. For example, we were able to rent $1,000 beginning of 2025. In 2026, we could only rent the same unit for $900, even $850. And when it comes to renew the current resident, because a lot of places are offering concession now, 1 month free, 2 months free, some of them even offer 3 months free. And also they would check your current rent. And once they saw the current rent you offer to the new applicants, they were lower than what they are paying for now, and they even get 1 or 2 months free of rent. They also want to get a lower renewal rate for a new lease. You have to adjust the renewal rate for them because you don't want to have one more vacant at your property. It takes way much longer to fill up a vacant unit. The occupancy pressure is increasing, and also in some of the areas, collections are weakening too. The delinquency is getting so high, and it's so hard to cut the number of the delinquency. Make a lot of deals become deadly. The refinance market changed. The lenders are getting so strict. Today, the value of many properties has dropped, and it's so hard to increase the value of the properties nowadays. That means the debt service cover ratio no longer work. We couldn't get that high LTV anymore. At this point, many of the owners or even operators stop funding the assets. Some of the operators or the owners just simply hand the keys back to the bank. They just took the losses. Even some of the properties, they were acquired at a very attractive interest rate, such as interest rate like 3.19, 3.5 from Fannie or Freddie. So what this cycle is teaching me, the operators who survive long term are usually not the most aggressive ones. They got the fixed rate and they only use conservative leverage. They didn't get a 80% or 85% leverage LTV to their investment and real cash flow, not just some aggressive projection on the spreadsheet, and strong reserves to make sure that there's enough fund to do any of the repairs or operation. And of course, operational disciplines. A lot of people thought success in real estate means buying big and bigger deals as fast as possible, but the real success is surviving circles. Because if we survive longer enough, another opportunity always comes. When I look at those multifamily foreclosures in those markets, I don't really feel so excited about it. Honestly, it's sad because many of these deals were bought with extremely high prices, and a lot of people put too much hope on those deals. But the market is now reminding everyone of something important. Risk was never eliminated at all. It was simply hidden underneath cheap money. They lost because they bought overpriced assets using assumptions that only work in a perfect climbing environment. And now the multifamily industry is paying the price for those years. The people who bought the assets at the right price would be able to build their wealth. And in real estate, what matters most is not how much money you make during the boom. It's whether we can still stay in the game after the circle turns, because as long as we are still on the table, then the next opportunity will still belong to us.